Hey, real estate investors, welcome to Cheyenne, Wyoming. Today we're talking about analyzing income producing investment property. We'll crunch numbers, cap rate, cash on cash, and more. I'll use a custom spreadsheet, which you can find on my website, horizonpeakre.com, or check out the link below. So let's start with my listing, 508 East 19th Street.
And I'm going to begin entering the values for this property. The rents for this fourplex come to $36.75 a month, which is $44,000 annually. And I know from the profit and loss statement that it gets about $450 a year in laundry income. I use 4% for my vacancy loss, which I find to be sufficient for Cheyenne, Wyoming, and our very strong rental market. So that gives us a total annual income of about $43,000. Now we need to put in our operating expenses. For this property, the tenants contribute a flat rate of $100 a month towards the utilities, which pretty much covers the utilities. I'm going to put a small amount in for utilities that the landlord would pay during a vacancy, $300 annually towards utilities.
Let's talk about maintenance. This property is in great shape, but it was built in 1915. Like many of the multifamily properties in Cheyenne, it's going to need some maintenance. I use 15% of rents as my estimate for maintenance and reserves.
The next fee we need to talk about is property management. Most property management companies in Cheyenne charge about 8%. You may be self-managing and be able to get away with not paying this fee, but I'm going to put in the 8%, assuming you are not. The taxes on this property for 2024 were $17.77. However, in Wyoming, we have a property tax relief for 2 years, 2025 and 2026. Those property taxes are going to be reduced by 25%. I'm going to estimate them to be 75% of the 2024 numbers, bringing us down to $13.33. Now for insurance, we know that the current owner is paying $1,800 a year. To get the rest of the expenses, I'm going to go ahead and bring up the profit and loss statement from the property management company to see what they've been paying for snow removal and cleaning. Now, this statement only goes through May of 25, and we can see that they had $385 worth of snow removal for January and February. Now, we can probably assume that snow removal is only going to be applicable in certain months of the year. So let's assume that that $385 is going to be spent again in November and December, bringing us to $770 a year. Cleaning, they appear to be paying $25 a month in cleaning. So let's go ahead and put in $300 a year annual expense. And now that we've entered all of that in, we have our net operating income, NOI. NOI is total income minus expenses. We have our first metric. Now that we have our NOI, we can enter in the asking price, and that will calculate a cap rate for us. The cap rate is simply the NOI divided by the asking price, and that gives us about 6.5%. I've also calculated a cap rate without the management fee in case an investor is looking to self-manage. Now we need to calculate the debt service. I have a calculator that I like to use for doing this. You can find mortgage calculators online that can help you calculate the principal and interest when you know the amount of the loan and the interest rate. The first thing we need to know is the amount of the loan, and most investors need to put 25% down. So I am going to put in the asking price of $440,000. I've seen investors lately getting 6.75% interest, so I'm going to plug that in. Now that we've entered in our debt service, we can calculate our before tax cash flow. Before tax cash flow is going to be our NOI, net operating income that we calculated above, minus our expenses, including the debt service. Now we can calculate our cash on cash return simply by taking our annual before tax cash flow and dividing by our total cash invested. If you remember, we're expecting to invest 25% of the $440,000 purchase price, so our denominator is $110,000. Now let's look at some after-tax scenarios. We need to calculate how much we're going to be able to write off for depreciation. Purchase price is $440,000, but that includes some value for the land, which I am going to assume is $50,000. Now we take the remaining $390,000 and we divide by 27.5 years, which is the amount of time the IRS gives us to depreciate a residential rental property. So that gives us a yearly depreciation write-off of $14,182. We have a before tax cash flow of $2825, which represents a profit. So you would think that we're going to be writing Uncle Sam a check, but not so, because we have depreciation of $14,000 that we can write off. Now, to know exactly how much this benefits you as an investor, I would have to make an assumption on your tax bracket. So I'm going to guess that you're in the 24% bracket. Notice that our profit previously of $2825 has nearly doubled to $4708, and that's due to the tax write-off. Real estate is a phenomenal wealth building tool, and that is in part due to the tax advantages. You can make a profit and not only not pay taxes on the profit, but get more money back from Uncle Sam because it looks like you have a loss on paper.
Now that we've run the numbers, you might be wondering, is this a good investment? Well, let's start out with, is 6.5% a good cap rate? Right now, the average cap rate for multifamily property is just a little over 5%. So this investment does outperform. However, there are a lot of different goals that you have to take into consideration when purchasing multifamily property. And there are intangible factors as well.
One of the key considerations when choosing an income property is the location. You'll get a better quality of tenant who will stay longer and take better care of your place if the location is desirable. A desirable location means someplace that's quiet, walkable, close to employment and attractions.
Here in Cheyenne, Wyoming, we've seen recent investments from Microsoft, Meta, and Google, all of which are building data centers here. This is a strong indication that our market will continue to appreciate at values above national averages and will continue to have a strong rental market. This likely means that prices will appreciate, and it may be a good idea to lock in now. And of course, it's a huge benefit that Wyoming has no state income taxes.
I'm Mariah Jeffrey with Coldwell Banker.
Reach out if you want to learn more about this property or talk about investing in Cheyenne. Tell me in the comments, would you purchase this property? Why or why not? Don't forget to like and subscribe.